Ladies and gentlemen, something unprecedented has just unfolded in the global financial system. Something so serious that 25 of the largest banks in America held an emergency meeting with the Federal Reserve behind closed doors. A meeting so urgent, so sensitive, it was never meant to reach the public, but it leaked. And now the truth is out. This past month has been unlike any other month we've seen in modern financial history. A month loaded with warning signs flashing red from every corner of the economy. BlackRock faced a 100% loss on a major private credit loan, adding significant stress to already fragile credit markets, signaling something deeply wrong beneath the surface. Tricolor filed for bankruptcy, setting off alarm bells throughout the lending world and causing institutions to reassess their risk exposure with real fear. Then came First Brands, the collapse of a $10 billion auto parts company, exposing hidden dangers inside private credit markets that almost nobody had been paying attention to. UBS was forced to shut down the Okcoinor funds, a clear sign that strain from First Brands is rapidly spreading across the system like economic contagion. Sonder, a short-term rental giant once valued in the billions, collapsed so abruptly the tenants were evicted without warning as the company imploded. Even OpenAI, a tech titan at the center of the AI revolution, publicly begged for a government backstop, with the CEO warning that things behind the scenes are very, very wrong. And as if that wasn't enough, new data just released shows US foreclosures jumping 20% in October alone, confirming rising distress in the housing market. So listen carefully, because everything is not okay, no matter how they want to present it on television or in mainstream headlines meant to keep the public calm. Cracks in the banking system are now widening into fractures, and the consequences are becoming impossible to ignore. And now we know why the Federal Reserve urgently called the biggest players in global finance to an off-record emergency summit they hoped the press would never discover. They gathered to discuss a signal that has been triggered, one of the most dangerous warnings in the financial system, showing that liquidity is evaporating and the system is losing stability. Why did the New York Fed quietly pull together 25 primary dealers, the most powerful institutions on Wall Street, without public notice or scheduled agenda? Because time is running out, and they know that once confidence breaks, the entire financial architecture can collapse faster than anyone expects. Here's the headline that confirms it. New York Fed convenes meeting with Wall Street firms over key lending facility. This was a hastily arranged meeting that was not previously reported and was only exposed after a leak from insiders who were present. The goal was not discussion. It was crisis management, because stress is spreading through the money markets that act as the bloodstream of the banking system. And what exactly is failing? The Federal Reserve's standing repo facility, a last resort emergency lending window that banks use when they are short of cash and can't borrow normally. For those unfamiliar with repo markets, think of them like a pawn shop for banks, a place where they bring collateral like treasuries in exchange for overnight cash to keep operations alive. When those rates spike dramatically, it means banks are running out of liquidity and the system is choking. This is exactly what has just happened. The rate on tri-party repo agreements jumped violently above the level set by the Federal Reserve, indicating deep stress and a lack of available cash. The last time repo rates spiked like this was 2019. And what came immediately after? The banking seizure, the Federal Reserve intervention, and the historic market collapse in 2020. The New York Fed confirmed that banks are struggling to secure borrowing near reserve levels, a major sign that liquidity is evaporating rapidly. Data shows an explosion in repo use to nearly $30 billion in a single night, signaling emergency borrowing on a scale we have not seen in years. Analysts warn that conditions will tighten further as banks move into year-end, when balance sheets are cleaned and risk is cut aggressively, and that means liquidity will shrink even further, pushing more institutions to the edge. The Federal Reserve publicly insists this spike was contained, but privately, they are terrified of what happens if the public discovers which banks were forced to use emergency lending. Because once a bank is known to be in trouble, The only outcome is a bank run, and we've already seen how rapidly these unfold. Silicon Valley Bank collapsed in 48 hours, the fastest failure in US banking history. The Fed hides the names of banks using the repo facility for 2 full years before releasing the information. The question is, why would they keep that secret unless the system is dangerously fragile? It is because confidence, not capital, is what keeps banks alive. And if people discover their money isn't safe, they pull it instantly, and the entire structure collapses like a house of cards. Lenders do not want to use the facility because they know it signals panic, weakness, and instability. And once that label sticks, the market punishes them brutally and immediately. Liquidity fear is what destroys banks, not insolvency itself. And now we're witnessing rising bankruptcies across sectors. BlackRock losses, Tricolor, First Brands, UBS fund collapse, Sonder rental failure, and foreclosure spikes nationwide. Every alarm is ringing simultaneously. Everything points to a system under severe stress and approaching a critical breaking point. The difference between now and the last crisis is that in 2008 and 2020, the Federal Reserve could print unlimited money and slash rates to zero. But today inflation is high, and they cannot print without igniting hyperinflation and destroying the dollar. So we are heading into a crisis unlike any we have experienced in modern financial history. This time, the Federal Reserve is trapped, with no good options left. Either they let institutions fail and allow the system to reset violently, or they step in, print trillions, and sacrifice the middle class through runaway inflation. Both outcomes end in pain. The only question is who absorbs it. And now that the emergency meeting is over, insiders are preparing. The public remains unaware, distracted, anesthetized, but those paying attention will be ready. This is not fear-mongering. This is reading the data, the reports, the statements, and the behavior of the most powerful banks in the world. The people who caused past collapses are silently preparing for the next one. The window to prepare is narrowing. And in the next part of this series, we will dive into why this signal matters, what happens next, and where the opportunity lies before the reset unfolds. Now that we understand why the Federal Reserve urgently gathered 25 of the most powerful banking institutions in America behind closed doors, we need to examine what triggered this emergency and what they are truly afraid of. Because when the repo market strains and liquidity evaporates, the entire financial system is moments away from seizing up. At its core, the modern financial system runs on confidence and access to short-term borrowing. If either fails, everything stops. Payments, settlements, payrolls, lending, and basic financial stability. The repo market is not some obscure financial instrument. It is the foundation of daily banking operations, the plumbing that keeps the global financial machine functioning. When repo rates surge above Federal Reserve targets, it signals a shortage of available cash. And when banks are suddenly unable to lend to one another, it means trust between institutions is breaking down. That is exactly what we are seeing right now. Banks are hoarding liquidity to protect themselves rather than lending to others. And that is how financial freezes begin. Every crisis in history begins the same way. Liquidity dries up before insolvency is revealed. And once confidence evaporates, the panic spreads faster than any central bank can contain. The last time this warning signal flashed was late 2018 and 2019. Back then, the repo crisis triggered emergency Federal Reserve intervention. Followed by the massive collapse in 2020, the world still remembers. This is why the Fed has already stopped quantitative tightening earlier than expected. Not because inflation has disappeared, it hasn't, but because the system was cracking internally. They needed to reverse course quickly to stop a catastrophic liquidity event. And this sudden pivot tells us everything we need to know. Something is breaking behind the curtain. The Federal Reserve publicly claims the facility is functioning as intended. Privately, they are scrambling to keep it from spiraling into a full-blown systemic crisis. If word gets out that a major institution used emergency repo borrowing, the market will immediately assume weakness. Investors will withdraw funds, depositors will panic, and a silent liquidity shortage can turn into a public bank run overnight. That is why the Fed refuses to reveal which banks tapped the facility. The names won't be released for 2 years. By then, the damage will already be done. Because the truth is simple. If banks were stable, they wouldn't need repo lifelines. Healthy institutions don't require last resort borrowing at emergency levels. And this is happening at the same time bankruptcies are accelerating across multiple industries. Corporate failures are no longer isolated events. They are now forming a pattern. BlackRock's private credit loan collapse is a red flag warning that risk layering is coming undone. Higher rates are exposing leverage that was hidden under years of cheap money. Tricolor's bankruptcy shows consumer credit stress is exploding. People cannot keep up with rising borrowing costs, and defaults are spreading rapidly. The $10 billion collapse of First Brands reveals deep cracks within private credit markets. A market many believe to be insulated from crisis is now facing shockwaves that are spreading through major lenders. UBS closing the Okcoinor fund signals that institutional distress is accelerating. Funds are pulling back exposure, freezing investment, and preparing for defensive positions. Saunders' collapse exposes the truth about the Airbnb-style rental bubble. Short-term rental empires built on debt cannot survive tightening credit and falling occupancy. Foreclosures rising 20% in a single month proves that households have hit the breaking point. People are losing homes not from lack of income, but from overwhelming debt pressure. And even OpenAI asking for government support confirms the magnitude of this crisis. When the fastest growing tech company in the world begs for protection, you know the system is unstable. These events are not coincidences. They are signals that the financial storm is gathering strength and time to prepare is shrinking. We are entering a phase where banks will restrict lending, tighten credit, and protect liquidity at all costs. This will squeeze small businesses, families, and investors, causing more defaults and more job losses. Unlike previous crises, central banks no longer have easy tools to fix it. In 2008, they printed. In 2020, they printed. Today, printing triggers inflation. Cutting interest rates quickly would ignite a currency crisis. Printing trillions again could collapse the dollar and destroy purchasing power for every American. So the Federal Reserve is trapped between saving the banks and destroying the currency. There is no painless exit. What comes next is a cycle history has repeated many times. A credit freeze, a liquidity crunch, and a cascade of financial failures. The system is entering a point where something must break to reset the imbalance created by 15 years of artificial money. And when that happens, the middle class will be the first to feel the pain. Those who see what's coming will adapt and survive. Those who ignore it will be blindsided when the wave hits. When transitioning now into the opportunity hidden inside this crisis, while major markets convulse and fear spreads, certain industries explode in growth. Government contracts, security technology, and infrastructure solutions surge during instability and transition. This brings us to one of the most compelling developments unfolding right now. A company positioned at the center of a multi-billion-dollar expansion driven by national security mandates. While banks are cracking, another sector is quietly preparing for explosive growth. Aviation security and federal protective infrastructure. And at the center of that shift stands Liberty Defense, trading under the symbol LDFF. This company has secured exclusive licenses, breakthrough patents, and government-backed development partnerships. They are working with DHS, TSA, MIT Lincoln Labs, PNNL, CBP, and even the Secret Service. Liberty Defense raised $45 million to develop its core technology. Yet today the market values the entire company at just $17 million. That valuation alone signals a massive disconnect between potential and current investor awareness. The flagship system, HexWave, uses millimeter wave screening and AI imaging to detect metallic and non-metallic hidden threats. A critical capability traditional metal detectors cannot provide in a world of 3D printed weapons. The TSA has now issued a mandate requiring 173 major US airports to implement employee screening by April 2026. This creates a huge immediate market for Liberty Defense solutions. Hexwave is already being sold to customers, including Los Alamos National Laboratory, and sales velocity is increasing month over month as airports prepare for mandate compliance. But the most important breakthrough is the TSA awarding Liberty Defense a sole source contract to upgrade more than 1,000 existing body scanners. A contract that could generate well over $100 million in potential revenue from upgrades alone. This is like turning outdated airport scanners into next-generation threat detection systems without replacing the machines entirely. A cheaper, faster, more scalable solution, exactly what governments prefer. And this is happening at a time when national security technology funding is accelerating dramatically. While other industries weaken, security and defense are expanding without hesitation. So while the financial system trembles under the weight of debt and tightening liquidity, this sector is positioned to surge as governments race to modernize infrastructure. In the next section, we will break down the timing, the catalysts ahead, and how this opportunity aligns with the broader economic reset. Because when fear dominates, wealth transfers, and the prepared always benefit. Now that we've established the scale of the crisis brewing in the banking system and the extreme measures underway behind closed doors, we need to understand what happens next, what the Federal Reserve is preparing for, and how the institutional elite is positioning before the next phase unfolds. Because while the public sleeps, the biggest players are shifting aggressively, and those who move early will define the next economic era. Every major financial collapse in history follows a similar pattern. Early warning signals appear. Insiders react. The public is reassured that everything is fine, and then suddenly the system fails. We saw it in 2008 with subprime mortgages, in 2020 with liquidity implosion, and now once again the cycle is repeating. The standing repo facility spike is not an isolated technical event. It marks the beginning of liquidity panic. When banks stop trusting each other and hoard cash, the system begins to freeze like blood thickening inside arteries. The Federal Reserve is now caught between two catastrophic outcomes: allow defaults and collapses to unfold naturally, or intervene and trigger inflation that could destroy the dollar. They are delaying the inevitable, but delay only increases the scale of the final explosion. On one side, the Fed knows that bailing out failing institutions again would spark outrage and accelerate inflation, already damaging American families. On the other side, letting banks fail risks triggering a deflationary chain reaction that collapses markets, jobs, savings, and the housing system. That's why they are moving silently, not publicly. They cannot show weakness without sparking panic, yet they cannot solve the problem without violating their own policies. The emergency meeting with the 25 largest banks wasn't about discussion. It was about planning the moment intervention becomes unavoidable. And if they're meeting now, it means they expect the crisis to accelerate soon. Look at the data. Corporate bankruptcies are rising. Consumer defaults are rising. And housing distress is accelerating quickly. Even the most optimistic analysts now admit that cracks are turning into fractures. The banking system today is more fragile than it was in 2008 because leverage is far higher, risk is more complex, and hidden exposure is everywhere. Private credit markets have ballooned into a shadow banking system, controlling trillions without regulatory oversight. The collapse of First Brands revealed the dark side of private credit leverage. This is acceleration risk, a single failure exposing deep structural weakness and spreading to institutions worldwide. We are witnessing the beginning of credit contagion, and once the dominoes begin falling, they fall faster than anyone expects. While all of this unfolds, governments and institutions are preparing for something bigger than an economic downturn. They're preparing for systemic restructuring. Because every crisis in history ends the same way. The old system collapses and a new system emerges. When banks fail, governments consolidate power. When currencies weaken, digital systems replace them. When fear spreads, surveillance and security expand. And when chaos hits, people accept change they would never allow in normal times. This is why the most explosive opportunities appear during instability, not calm. While the crowd retreats in fear, the elite positions for transformation. And that brings us back to Liberty Defense. A company sitting at the intersection of the two most explosive trends, of the next decade: national security expansion and technological infrastructure modernization. As banking collapses and inflation squeezes households, governments accelerate spending in sectors they cannot afford to delay: security, defense, and critical infrastructure. Airports are not optional. Border protection is not optional. Threat detection is not optional. Liberty Defense is positioned precisely where demand will surge, no matter what happens in the economic cycle. A company with breakthrough technology backed by the same institutions that shape national security policy. Hexwave has solved a fundamental problem the world has ignored for decades: real-time detection of metallic and non-metallic weapons without slowing people down. The ability to screen 700 people per hour without removing jackets, emptying pockets, or creating airport bottlenecks. In a world where conflict, instability, and extremist threats are rising, this technology arrives at the perfect moment. And the TSA mandate requiring 173 major airports to implement employee screening by April 2026 transforms this from a possibility into inevitability. A sole source government contract is the ultimate competitive advantage. It means no bidding war, no rivals, no price pressure, only execution. And with more than 1,000 US body scanners eligible for upgrade and another 601,000 internationally, the revenue potential is massive compared to the company's tiny current valuation. A $17 million market cap company positioned to capture a multi-billion-dollar opportunity. That is why large investors quietly accumulate positions before catalysts hit headlines. That is why institutional attention is rising even while retail investors remain unaware. This is exactly how wealth transfers happen. Not when everyone knows, but when almost nobody is paying attention. Now zoom out and connect the dots. A banking crisis emerging, liquidity cracking, inflation limiting policy response, government security mandates accelerating, technological modernization exploding, and a company sitting directly in the path of required spending. Smart investors always look for asymmetric opportunities. Small downside, huge upside. This is the type of setup they wait years for. But let's be absolutely clear. None of this is financial advice. Everyone should do their own due diligence and evaluate all risks carefully. This is simply a moment where a rare combination of crisis and innovation intersects. And those who recognize opportunity during fear are always the ones who benefit most from the reset. The world is entering a new financial era. One where debt-based systems unwind and real value emerges from necessity, not speculation. The question is, who will be prepared and who will be caught off guard? The warning signs are everywhere now, louder than ever before. And anyone still pretending everything is fine is choosing denial over protection. So what do you think? Is this the beginning of the next major contraction? Or will the Fed attempt another rescue operation that unleashes inflation beyond anything we've ever seen? Let me know in the comments below. For those still watching, you're the people who don't sleepwalk through history. You prepare for it. Thanks for watching, and I'll see you in the next video. Stay safe, stay informed, and stay ready.